Trade power today is not exercised through loud threats or broken deals. It moves quietly through contracts, capital flows, and long-term positioning. And right now, Canada is redesigning how its resources move, not away from the United States, but around it. Welcome to Geocapitalist. Today's analysis examines why Canada is quietly redesigning its resource strategy around the United States, not through confrontation or retaliation, but through structural adjustments that reshape leverage over time. This shift is already influencing supply chains, investment decisions, and industrial planning across North America. If you value this type of geopolitical analysis focused on trade, energy, and industrial strategy, consider subscribing. Now, let's break down what's really changing and why it matters. The assumption that the largest buyer always holds the upper hand has shaped trade policy for decades. In resource markets, scale appears decisive. A vast consumer base, deep capital markets, and logistical reach seem to guarantee influence. Yet this logic overlooks a constraint that matters more than volume: time. Energy systems, mines, smelters, and transport corridors are built over decades, not quarters. Suppliers decide where to expand, which grades to prioritize, and which standards to certify long before prices move. When leverage relies on short-term pressure, it collides with long investment cycles and physical limits. Buyers can signal displeasure. Suppliers control future capacity. That asymmetry weakens dominance. Moreover, resources are not perfectly substitutable. Geography, quality, emissions profiles, and regulatory trust narrow the pool of credible alternatives. As a result, attempts to exercise leverage through uncertainty often backfire, accelerating diversification rather than compliance. The real power in resource trade lies in alignment: predictable rules, stable demand, and shared timelines. When alignment erodes, suppliers do not capitulate, they recalibrate. The outcome is rarely a rupture. This shift rewards patience, credibility, and disciplined capital allocation. Pricing pressure in resource markets rarely appears as a single decision. It emerges from signals that alter expectations: tariff risk, permitting delays, standards divergence, and rhetoric that clouds planning horizons. These signals change how contracts are written, how volumes are hedged, and how counterparties value reliability. Long-dated agreements embed risk premiums when uncertainty rises, raising costs without any formal demand. Suppliers respond by shortening tenors, redirecting optional volumes, or prioritizing customers offering clarity. None of this requires confrontation. It is the arithmetic of risk. Importantly, pressure aimed at near-term prices can undermine future supply economics. Capital budgets are forward-looking. Developers discount projects when policy volatility threatens returns. The result is less incremental capacity where pressure originates and more where rules appear durable. Over time, this shifts bargaining power away from price takers toward capacity setters. Markets then reprice reliability, not volume. What looks like leverage today becomes fragility tomorrow, as supply chains optimize around predictability rather than proximity. The lesson is straightforward. Stability lowers costs, uncertainty taxes them. In resource systems, that tax compounds quietly, shaping trade flows long after headlines fade. Modern supply chains are designed to absorb shocks before they become visible to policymakers. Procurement teams, not ministries, are the first to react when uncertainty rises. They adjust inventories, slow orders, and diversify suppliers to preserve continuity. These decisions are incremental but cumulative. A delayed shipment here, a postponed expansion there, gradually reshapes trade flows. Capital expenditure follows the same logic. When risk increases, projects are deferred, redesigned, or relocated. None of this requires new laws. It is driven by internal risk committees and financing constraints. As these adjustments compound, governments often misread the outcome as sudden disruption. In reality, the shift began months earlier. Supply chains favor optionality over optimization during uncertainty. Redundancy replaces efficiency. Distance matters less than reliability. This is why industrial stress appears at factory gates and construction sites before it reaches official statistics. By the time policy responds, supply chains have already adapted. Reversing that adaptation is difficult because sunk costs and new relationships harden quickly. The quiet reconfiguration becomes the new baseline. Over time, this baseline defines competitive advantage across regions and industries globally. Canada's position in resource markets rests on attributes that compound over time. Abundant reserves matter, but credibility matters more. Stable regulation, enforceable contracts, and predictable permitting reduce risk premiums for long-lived assets. Infrastructure reliability, from ports to pipelines to power, anchors delivery certainty. Emissions profiles and traceability increasingly influence buyer decisions, narrowing the field of trusted suppliers. These advantages create options. Canada can choose where incremental volumes go, which projects advance, and which partners receive priority. That choice is leverage. It does not require withholding supply. It requires steering growth. Because capital is scarce and timelines are long, small directional decisions today shape market structure tomorrow. When buyers compete on price alone, suppliers compete on reliability. Canada's framework favors the latter. The result is resilience during volatility. As markets search for stability, suppliers with credible governance attract longer contracts and better financing. This reinforces advantage. Over time, structural strengths translate into bargaining power that outlasts cycles and personalities. Geography, alliances, and investment discipline further magnify this leverage across energy, minerals, and industrial inputs over decades and multiple market cycles globally. Reducing dependency without rupture requires design, not declarations. The first lever is destination mix. By allocating incremental volumes to multiple regions, suppliers dilute single buyer risk while preserving existing ties. The second lever is contract architecture. Longer tenors with clearer rules reward predictability. Optionality clauses manage volatility. Third is sequencing investment. Projects are advanced where permitting, financing, and offtake align, while marginal expansions wait. This is recalibration, not decoupling. The United States remains a core market because proximity and scale endure. What changes is exclusivity. When exposure is diversified, bargaining becomes collaborative rather than coercive. Suppliers gain the freedom to say yes selectively, which stabilizes pricing over cycles. Importantly, this approach lowers systemic risk. It avoids headline shocks, keeps current flows intact, and signals reliability to all counterparties. Over time, diversified exposure attracts capital at lower cost, reinforcing discipline. The outcome is quieter power, fewer confrontations, more leverage. Relationships persist, but on terms shaped by durability, not urgency. In resource trade, that distinction determines who sets the tempo for long-term investors, industries, and governments navigating cyclical markets together across borders sustainably. Industrial consequences surface where margins are thin and planning horizons are short. Manufacturers, builders, and utilities feel cost volatility immediately because inputs flow daily. When uncertainty rises, procurement shifts from optimization to insurance. Firms hold more inventory, diversify suppliers, and lock in power and materials earlier. These choices raise costs before policy registers change. Financing amplifies the effect. Lenders price risk quickly, increasing spreads or shortening maturities for exposed projects. That pressure cascades through bids, schedules, and employment. Executives respond pragmatically regardless of messaging. They redesign footprints, adjust product mixes, and reprice contracts to protect continuity. This is why industrial regions experience stress ahead of capitals. Data lags obscure causality, but balance sheets do not. Once firms adapt, reversals are rare. New suppliers earn trust, logistics reroute, and standards align elsewhere. The feedback loop is quiet but decisive. Over time, industry signals accumulate into macro outcomes that policymakers later interpret as structural shifts. In reality, the structure moved first. Understanding this sequence explains why leverage debates miss the point. Industry behavior, not declarations, sets the trajectory for North American supply. The most misunderstood element in resource trade is the difference between current supply and future capacity. Existing flows are governed by contracts, infrastructure, and regulation, making them resilient to short-term tension. What shifts first is not what moves today, but what gets built tomorrow. Capacity decisions determine who controls optional volumes 5 or 10 years out. When investment slows in one corridor and accelerates in another, leverage migrates quietly. Buyers focused on near-term pricing often overlook this transition until it is complete. By then, alternatives are embedded in steel, concrete, and balance sheets. Suppliers that manage capacity rather than headlines shape market structure without disruption. This is why strategic redesign favors patience. Maintaining supply preserves credibility, while redirecting growth reallocates power. Over time, capacity determines reliability, and reliability commands premiums. Markets then reward those who anticipated constraints rather than those who reacted to them. The distinction explains why stability attracts capital during volatility. Capacity is the long game, and those who set its direction quietly influence prices, partnerships, and industrial geography for decades across modern global resource systems worldwide today. These dynamics reshape the economic balance between Canada and the United States without visible confrontation. Trade continues, infrastructure operates, and contracts are honored, yet leverage evolves beneath the surface. As Canada redesigns its resource strategy, it anchors relationships in durability rather than urgency. This recalibration alters negotiations across energy, minerals, and manufacturing inputs. Buyers accustomed to dominance must compete on stability, not pressure. Suppliers with options gain negotiating room, influencing terms, standards, and timelines. Over time, this balance favors coordination over coercion. North America remains deeply integrated, but integration alone no longer guarantees leverage. Strategic optionality becomes the deciding factor. The result is a quieter form of competition, one measured in investment flows and capacity placement rather than headlines. For policymakers, the lesson is structural. Sustainable advantage comes from predictability and alignment, not episodic pressure. For industry, it reinforces a simple rule: plan for reliability, not rhetoric. This shift defines the next phase of Canada-United States economic interaction, where power is exercised through design, patience, and long-term commitment across modern North American industrial and resource systems today, together broadly. Canada's repositioning illustrates how power operates in modern resource economies. Instead of dramatic breaks, influence shifts through design, timing, and credibility. That is why understanding why Canada is quietly redesigning its resource strategy around the United States matters beyond this moment. It reveals how trade relationships evolve when stability becomes scarce and capital seeks certainty. The implications extend across energy, minerals, and manufacturing, shaping costs and competitiveness for years. For North America, the path forward is not isolation, but recalibration grounded in predictability. As markets adjust, those who plan for long-term alignment set the rules others follow. This is the quiet logic guiding today's resource decisions. If you want to continue exploring how industrial strategy, supply chains, and geopolitics intersect, watch our next Geocapitalist video. We will keep breaking down the forces shaping global trade with clarity and context. Thank you for watching, and see you in the next video, where long-term economic decisions quietly define leverage, resilience, and prosperity across Canada, the United States, and the broader global system over the coming decades ahead for all participants involved worldwide.